Well, when I say welcome back, I mean this has been a long time since I've had the two of you here to work for those folks that are joining us here today. And by the way, there may even be some people here that have never met you guys before. So I want to take a second and introduce them to Chris Pedersen. Chris is our Director of Research. And Daryl Bahls is our director of analytics. These guys do as volunteers, completely volunteers, a yeoman's job of helping put the things together that I think makes it possible for many of you to become better investors. And Daryl, he's basically responsible for most of the 200 plus tables and graphs, and Chris is responsible for the best in class ETFs and the two funds for life strategy. And both of them are real straight shooters. They have an understanding of numbers at a whole better and higher level than I do. So it is really lucky that we've got them on our side. And today we're going to take some Q and A's, and hopefully before we went on, Chris recommended a discussion for, he didn't say the next one, but I'll tell you when he discussed it, I said, this has got to be the next one. So I'm not going to tell you what it is. I just want to tell you when we have our next gathering, the three of us, I hope you will be here because it's going to be very interesting. But for today, we've got some great questions from people who follow our work, and one of them comes from Dave, and he says, first of all, I want to first thank you for all that this team publishes. I read everything that I can from Paul and the group that the team publishes. And he asks, in the ultimate buy and hold fund recommendations, why is a mid-cap fund not recommended? Is it because there's enough mid-cap exposure in the S&P 500 and value index funds? He says he invests in Vanguard index funds almost exclusively. And by the way, I think we should address that as well. I somewhat follow the ultimate buy and hold in my Roth IRA. However, I do hold about 10% in a mid-cap fund, etc. I'm wondering if I should sell one or the other being a value index, and just move the balance into the S&P 500. Any thoughts or recommendations? Who wants to take that one to start? Anybody?
Well, Paul, you were the initial source of our portfolio constructions, the ultimate buy and hold, and the others. So maybe you can say why was mid cap value left out, or mid caps left out in the original construction?
You know something, Chris? I haven't thought of it in that light. That goes back to the mid 90s and why it didn't. I guess that it had to do with the information I had gotten from the academic community. Having gone through the 2 day or 3 day workshop that Dimensional Funds put on, that's where I got a lot of my early information, and it opened the door to a lot more study from the academic point of view. But the idea, as much as possible, was to put together these equity asset classes that, according to the academics, were all built to return a premium, and all of them, theoretically, at least at that point in time, if it wasn't a premium, it was going to be about the same return, but maybe not be as correlated. You might have something in there because it's going to reduce the risk rather than raise the return. So that was not in what the academics recommended. But, and I suspect part of that may be because it's a very similar, it's a market based of sorts equity asset class. I mean, it's not as unique as the emerging markets or as unique as REITs might be. But I want to show, in fact, I want if you give me a second here to, can you let me share?
Oh, yes, go ahead.
So here are three different equity funds that represent one small cap value, one mid cap blend, and one the S&P 500 large cap blend. And over this period of time, and by the way, we've talked about this period of time many, many times, and you remember that this was a period of time where the market had just experienced a 17% compound rate of return for the previous 25 years. And so now we're looking at a 25-year period where the return isn't anywhere close to that, because all of these, while the mountain looks like it's a good ride to be on, is about half of the return that was experienced on these asset classes in the previous 25 years. But in this particular period, what we see is the S&P 500, the green, is up 745%, and the mid cap fund is up 100 and or 904%, and the small cap value from DFA, one of two, was up 1,208. And so you got this, they all performed as expected in that the higher return came from the higher risk. If you were to own a 50-50 portfolio or one third in each, you would get over this period of time, not knowing what rebalancing might have done to that return, but it probably would have been a similar return to having half your money in the S&P 500 and half your money in the small cap value. So there's nothing wrong with it. In fact, I asked myself if you were going to use a two fund strategy with the small cap value and the S&P 500, would you do about the same if you simply owned the mid cap? And you might. That may be the outcome. But again, and I don't have the work here, what we don't know is what happens when you start rebalancing this different combinations. But it's no harm to the portfolio to have mid cap, but it is one more asset class. And we started at 10, didn't want to go to 11, and now we're finally down to two or four. And so the inclination is not to add any more asset classes than we have to. So, but
Well,
it's
Paul, at the risk of disagreeing with you, but maybe making it more interesting, I think there is a little bit of harm in adding mid cap, and that's that when you go to rebalance, it's less efficient because now you have an even greater amount of overlap between the funds that you have, and so there's more work involved, there's more decisions involved, more emotion involved, and more trading costs involved because you're going to be trading out of a mid cap fund when it's out of balance to get into a small cap or a large cap. And you're going to do that more frequently if you have large, mid, and small than if you
Mhm.
have large and small. And you're going to pay money to sell something that you buy right back in another
Mhm.
fund. So to me, the biggest
Interesting
argument
because
against
of the overlap, right,
yeah,
Chris?
yeah, it gets at the overlap. The
Right.
biggest argument against mid is that it's weak sauce. It's like saying, why don't you change your recipe and your dinner recipe to instead of having salt and pepper, having salt, a mix of salt and pepper, right? Yeah, you could do that. You could do that, and you can even probably buy a mix of salt and pepper and cook that way if you want to. And if that lets you sleep at night, great, you go for it, you know. But I just don't, it's kind of silly. Most people don't need it. You can get the same result by using the more concentrated ingredients.
Good point. Good point. And
And I think also that having more funds or more asset classes doesn't necessarily get you a better return.
No, yeah.
well, as a matter of fact, if you look at the return of the four fund strategy over
Yeah.
the 90 plus years, it is 11.8, and the two fund strategy with the S&P 500 and small cap value is 11.9.
Let me show you something here for a second, if I can. This is over here that is at the right this is the compound annual growth rate over the last 50 some odd years for a selection of the sound investing portfolios as a function of the equity allocation. But if you go over here and you look at the end, this is the pure equity portfolio. But the red one is one fund, the green one is 10 funds, the gold one is 4 funds, the purple one or pink one is 2 funds, the black one is 2 funds, and the blue one is 1 fund. So it depends on what the funds are. So just adding another asset class or fund, the blue up here is all small cap value. The red is the S&P 500, and the green is the ultimate buy and hold. The gold is the 4 fund, and the pink is, what is it? Oh, that's the 2 fund, the S&P small cap value split. And the black is the small value and large value. So,
And those three that are really close together in the middle are all half in large, half in small, half in value, half in blend. So they should be close together.
yeah, the pink, gold, and green are half and half type
Yep.
funds
Yep.
in terms of large and small. And
Good.
The difference is that the more concentrated the spices you're cooking with, the slightly higher returns you get.
yeah,
Yep.
now there are other considerations here like standard deviation and max drawdown and
Yeah.
sleeping at night and things like that. But this is just pure compound annual growth rate return. So you can see how it depends on what the funds are. It's just not the number of funds. So having 10 funds and now you're going to add another fund, that doesn't necessarily make much, if any, difference, in my opinion.
So here is an email I got in December of 2016. And it was from a young fellow just got out of college, had his job with a new bank or a new job for him at a bank. And he'd been struggling figuring what the right equity asset allocation would be within his 401k. And he goes on to ask some other questions. And he has been asking questions ever since. And he's a wonderful young guy with a strong desire to get it right. And I think folks who are trying to get that perfect portfolio may not waste time worrying so much, but at some point you kind of get it the best you can, and you hopefully are able to stay the course for the long term. Because the obvious problem is these asset classes come and go in terms of being in and out of favor. And that can drive the person who wants to fine tune and somehow corral that risk. It's a lot of work and it's a lot of emotion, I think. And so it didn't surprise me when he recently sent an email where he says, I'm rebalancing my retirement account strategy. Can you give me your thoughts? There's just about $20,000 in there now. And we've all looked at it. And this is not something that we do as a service through the foundation. But I think that when we have a situation where in sharing our thoughts about it, it's going to help other people as well, I think it's worth the effort. And so, Daryl, I think you took a whack at this and looked at the portfolio and had a comment, and I think you did as well, Chris. You guys want to take it away?
So here's the portfolio he had kind of thought he had settled on and had asked some questions about. And when I looked at this, one of the things I had several thoughts, but one of the first thoughts that hit me was that the Schwab large cap growth ETF and the S&P 500 ETF are in large part the same asset class, really. And in fact, they have significant overlap if you go and look at that. And Chris discovered a tool here a while back that we've used to look at fund overlap. And if I put these two funds in that tool, the SCHG and IVV here, you can see that they have significant overlap. 59% of SCHG is in IVV, and 25% of IVV is in SCG, is in SCHG. Why can't I say that? And overall, on a weighted basis, they're half of each other. So I would pick one or the other, and go with it. Go with whichever one you think you would stick with the best. But I don't see any reason to have both. I did look at the other three funds, other two funds, I guess he had, and in there, and there's not much overlap. Of course, there's no overlap with the emerging market, and the overlap between the small value fund and either of these two funds it's less than 10%, if I remember correctly. So that's not too bad. So.
And Chris, did you have anything you wanted to add there?
Well, as you pointed out, it's not a portfolio we recommend. It's relatively weakly tilted towards small in value. And that may be what it takes for him to stay the course, because it means that he's going to have less tracking error from the market overall.
Yeah.
One of the things I didn't have time to do, but I wanted to investigate, is how different what he has is from the total market. I think it tilts a little bit towards small in value, but not a lot, which is going to give him a little bit of a premium, expected premium, I should say, and a little bit, a tiny amount of additional volatility, probably because of the diversification benefits. But again, it goes back to, investing's personal. If that's the degree to which his confidence in small in value lets him invest, and the degree to which he can invest and stick with it and not be concerned that, oh, I spent 2 years, 5 years, 10 years of missing out on the premium, then that might very much be the right thing for him to do. And that's why in Two Funds for Life, I've usually started it by exploring what happens when you add 10% of small cap value, 20% of small cap value, all the way up to 50%. Because I think for a lot of people, their confidence in that as a diversifying bet paying off is understandably weak, because it's not guaranteed. So when I look at his portfolio, I see humanity. I see a human being. I see somebody
Yeah.
doing what works for them, and I'm empathetic. That's all good. That's fine.
Well, and there's another portfolio of funds here that was in his package that I printed it out here, and he's got 10% in small cap in this particular portfolio, small cap growth, and the 10%, 30% large cap growth. And in the case of small cap growth, if you go back to 1928, if you want to believe what the academics have found, while the compound rate of return is of small cap values around over between 13 and 14, the growth, small cap growth, is under 9.
Yeah, I would. That's one of those where if it was a friend of mine, I would pull them aside and say, you really might want to consider getting out of that, moving it into your other asset classes. Yeah, because the history is not on your side. And I think there's a really logical, intuitive explanation for why that's a dangerous place to be. Small companies draw capital to them by telling a story about how they're going to grow, how they're going to be different, how they're going to create a bright, new, shiny world that is much bigger and different from the one that exists today. And the really, really good storytellers, the charmers, are the ones who have zero finances today and tell a genius story and attract all kinds of money. And unfortunately, many of them fail and never produce a profit. And so that's why small companies are volatile and small companies are riskier. But the small growth companies where the finances are weak and the story is strong, that's where the greatest danger is. And so I try in my fund selection, my portfolio construction, in my own investing, everywhere I can to avoid that bottom right hand box, avoid small growth because it's just too dangerous and for what? Not a high expected return. Yeah.
And I think in both large and small, the PE ratio of growth is about twice that of value. So you're paying a big price to get that exciting future that they're hoping for.
Yep.
So my long-term friend, keep the questions coming. I like them, but I do want to be careful. We're not investment advisors.
Nope.
We can't give personal advice, and so we give this in a general way, if we might look at it that way.
On the plus side, I think he knows that because he's chosen to do something different from what we recommended.
Yeah, that's you see that's when I'm telling my wife all the hard work that we're doing to try to get people to do a certain thing. And then they write these emails. There are so many nice statements in these emails about the work that we do. And I look at what they're doing. And I say, well, why aren't you doing what we suggest? And so
I
it's
don't take it personally, though. They're doing
yeah.
what's best
Oh
for
no.
them.
Oh,
Yeah. They're doing
actually
what's best for them, and that's great.
it's quite fun. So Tim writes, uh, 58 years old with 2.5 million in taxable equity accounts, which suggests that he may have more money than that if he's got retirement accounts. And he started 5 years ago to educate himself. And he also started working with an investment advisor. And he has finally sensed that he's ready to do it himself and to eliminate that 1% fee. And 1% of $2.5 million, that's a big fee. Uh, During this time, he became aware of Bogle and the Boglehead method. By the way, I'm not sure I know what the Boglehead method might be the three fund strategy. And But he's decided to go with an hourly advisor. And he didn't ask the question as such. He wanted to know what was the name of that advisor that I had mentioned to a bunch of CPAs on a piece I did, a video for CPAs. And I didn't mention the name, but I mentioned her work. And so I gave him her name. But there's a challenge. There's a big challenge when you take the work from the people that you've been watching for many years and you watch our work, and you've done that for some time, evidently. The problem is you walk into one of these hourly advisors, and in most cases that I have found, they already have their own portfolio. And in most cases, those portfolios are pretty doggone simple. And the reason they're simple is because they are working hourly to tell you what you should do to send you home to do it. The reason they get $200, $300, $400 an hour instead of 25,000 is because they're not pulling the trigger. They're asking you to pull the trigger. And so they know that the highest probability from their experience of getting you to actually do it is to make it very simple. And then you come in to the advisor and you say to the advisor that you would like to use this strategy that Merriman or Swedroe or Jim Dolly, whoever it might be that you're thinking you want to do, but it incorporates a number of different equity asset classes that that suggest high emotion at some point, possibility of disappointment at some point because these things don't all move together. And I am going the last of July, early part of August, to actually speak at a conference of advisors at Garrett Planning Network. And my goal for that trip, part of it, is to find advisors who will work with people who want to use the four-fund strategy and don't want to push their own strategy down the investor's throat, even though I know why they're doing it, and I know they believe they're doing it in your best interest. That, of course, is also the nature of competition. We think we have a really great strategy. They think they have a really great strategy. And either way, you're probably going to be fine. But in many cases, the people that go to that hourly advisor, I know from experience, want to apply the work that we have done. And they even want to use the ETFs that Chris has recommended. So I'm going to do more and know more by the end of this summer about how we're going to make some headway in dealing with hourly. And by the way, the other thing is I'm going to meet some advisors who are going to convince me that they are good ones to use using our work. And if I could just find half a dozen to a dozen of them, I would put out a list so that people could interview them. That's the project. So here's the question I know we're not going to answer, but I want to read it because I want people to understand why. I have a position in VOO with 135,000 long-term gain. I want to sell the entire position and buy another stock. What's the best way to pay the least amount of taxes? Sell everything at once? Well, I said that we don't try to nudge people in a particular or give people direct advice on the portfolio for them individually. I even am further away from willing to touch any piece of tax advice. There are so many questions to be asked, and we could literally be sued if we were giving tax advice and it didn't work out. So, Chris or Daryl, do you guys want to give tax advice today?
I don't want to give
No.
yeah,
Yeah.
neither of us want to give tax advice. Uh, he didn't say how big the holding was. He just said he had a gain, right?
That's right.
That could be a 1%, it could be a 5% gain. I have no idea. And he also didn't say what he was trading into. So, if he's trying to get out of VOO to go into another large cap blend fund, then the benefits may be swamped by the taxes. You don't know, right? He didn't say anything about what his tax brackets are. He may have some room to do some trading at zero cost up to a certain amount. You can realize some capital. It may be his whole, well, actually, that whole trade, that capital gain would be greater than a year's exemption. But anyway, he gave us insufficient information and we have insufficient expertise. I think that is the right answer.
But who would be a CPA or tax
Yes,
accountant?
yes.
Absolutely. And I want to mention just a quick comment from Tom. Tom says I should stop focusing on this saving for retirement. He has suggested something. Uh, he suggested we think in terms of saving for freedom, and
Amen.
I think that's a great way to think about it. And I've attended a couple of these free hour and a half, 2 hour sessions that they're having at Rebel Finance in the UK. And boy, that is the attitude they have. Is we've got to picture what is the why we're saving, and I think the saving for freedom. At the end of the day, I guess that's what I was saving for as well.
I'm not going to get it exactly right, but I think Rob Berger's tagline is financial freedom is the best thing money can buy. It's close to that.
Oh, I like that. I
Yeah.
like from a resident physician uh, who likes our work. And by the way, gives amazing kudos to you guys. Uh, I'm not going to read it, not because he didn't mention me, but you guys would blush if you heard this, okay? But I will tell you what he'd like us to do. He would like us to create a video or a podcast explaining the differences between various DFA ETFs and Avantis ETFs so that people would know how to evaluate how to put those together in a portfolio. Now, at some level, Chris, you've already done that, but we haven't looked at the whole the whole series of equity asset classes they have. Have you looked much, by the way? I guess I assumed you haven't spent much time doing that. Have you looked at their whole product line?
Uh, no, in both cases, I haven't. I look for the asset classes that are part of our recommended portfolios, and outside of that, I have a cursory knowledge of both families. It would be a lot of work to do, and I'm not really sure that I'm the best person to do it. Morningstar spends all day, every day, trying to
Oh,
compare and
right.
contrast these various funds, and they try to compare within, for example, a stock style box. Different. So when they give a star rating or a recommendation rating, it's based on their comparison to peers in that same kind of investment. So I think there are a whole bunch of people who do a way better job than me on that one. And I guess within the work that we do, the best in class ETF recommendations, you can see birds of a feather. You can see that the DFA and the Avantis funds in various categories are very close in their relative estimated returns. Close enough that often I think you could flip a coin and just pick one. Um, and that's because of their philosophy being so rooted in academia in both cases. They use many of the same portfolio construction and management techniques.
It would be interesting. I think you have done some of this work, certainly, in coming up with your best in class. When you start looking at the commitment, like they each have their own total market index, but
Hmm.
they're not exactly the same.
No.
I don't know how much difference it would take to actually long term make a difference, and if that difference would be 1/10 of 1%, or if it would be a quarter of 1%, maybe it's someday worth taking a look at only in the area that we use, which and that's what you're doing when you go through and pick the best in class.
Yep.
I'm just curious, have you ever had two, one that Avantis and DFA have basically the same, where it
Yes.
was really
What's that?
almost all the same. Always are they very, very close in every case?
You'll find more differences in the holdings typically than you will in the performance or the tilt to small in value. They're not the same, they're not clones, but they are sometimes so close for a category that if you looked at the expected returns, there's not much difference. And so if you peeled the onion, you looked under the hood, you might say, well, they have different companies. Why is that, right? If yeah, the top companies are similar, but even there, there's some differences. Why are the returns the same? That goes back to the academic research. The academic research says that what drives your returns is primarily the size of the company, the value of the company, the market exposure you have, the momentum that you get out of the trading, the quality, yeah, the quality. So it's the exposure to all of those different attributes, and you can get the same attribute exposures a lot of different ways. You don't have to have the same named companies under the hood to produce two funds that have very similar expected performance.
So to the extent then that I don't mind owning more funds, what you're telling me is that they're both capturing the premium,
Yeah,
and they're doing it with different companies. Now, I'm going to bet there are going to be years that the difference in returns could be a couple percent, maybe.
sure. Yeah,
And so, but it also says to me that if they don't have the same holdings, but they're doing the same thing in essence, and they must have their rules must be a little different
yep,
because if their rules were the same, they'd own the same companies theoretically.
yep. Oh,
So
and
it
I'm
says,
sure I'm sure if you sat down and you talked to them and asked them why they're different, they would have a story,
yeah,
right? It's like, oh,
yeah,
we do more of this and they do more of that. Yeah,
yeah,
I'm sure there's a story there.
yeah.
Yes.
But I would have more diversification. I might have, instead of 700 companies I would have with one, I might have 1,000 companies, and that wouldn't be bad.
Yeah, I
Wouldn't it?
absolutely agree. Yeah, it's not it's not a bad strategy if you're comfortable and I wouldn't even worry about rebalancing. I would be quite comfortable splitting my small cap value holding between two good funds and letting them ride. You could
Oh,
rebalance,
within
and
the within the asset class.
yes, within the asset class.
Yeah,
You
yeah.
could you could rebalance, and you might get a little bit of an advantage over the long term, but you could also ignore it and it probably not be hurt by it because it's since they are within the same asset class, I wouldn't expect one or the other to outgrow the other one substantially, especially if they have similar exposures to the various attributes that drive returns. Yeah.
That's great. Wonderful. So here's a question from Richard. He says, you've mentioned that you invest your granddaughter's future money in a combination of AVUS and AVUV. I am wondering why you chose that route versus choosing more diversification with AVGE. What would you guess, Chris?
Well, let's jog people's memories on what each of these funds are,
Great.
right? AVUS is US total market with a tilt towards small in value. Uh, AVUV is US small cap value, and AVGE is Avantis All Equity Markets ETF, so that includes international, right?
Right.
And it also has a tilt towards small in value. So AVGE is going to have less of a tilt towards small in value than a 50-50 combo of AVUS and AVUV, right?
Yep.
It is going to have the international component. I think you miss a teaching element though. When you own AVUS and AVUV as a young person and you invest like Rip Van Winkle, which is awesome for a buy and holder, right? Because that means you're not fretting with the up and downs as you go through. You got enough up and downs in junior high and middle school and high school, right? I mean, you don't need to worry
Right.
about the stock market. You got a lot of emotional, like roller coaster stuff to go through. But hopefully that means that your granddaughter peaks around when she's 18 and she's going to get when she peaks, or maybe she peaks once every 10 years, whenever, she's going to get a lesson. She's going to learn that these different asset classes behave differently at those different points in time. And it's hopeful that she gets the right lesson, that she learns that the more volatile asset class had a higher expected and higher delivered return. If
Yeah.
you mix it all together in one fund, I don't know what you'd learn, right? You wouldn't learn that international outperformed US or US outperformed international or that small did well or value did. You wouldn't learn anything. So that's my answer. I think it's better to give them those two things with the higher expected return and the teaching opportunity. But Paul, you're the one that did it. So what's your
No,
thinking?
well, the reason I did it was because, first of all, she is going to have a video and a letter handed to her. I'll probably not be around anymore. And my wife and I are going to communicate with her in several different ways about why we did what we did and what that money was for, in the hopes that she would feel some commitment to using that money to fund retirement accounts. That's the reason that we're giving it. And my thought was, I want to show her how small and large and value and growth, how they perform over. She'll have 18 years of performance. She will hopefully see years that the S&P 500 was best and that small cap value was best other years. I'm hoping that she will see that small cap value has made a better rate of return. I would love it if it looked like, 2000 through through 2025, because that's a picture that I think she would always remember how good it could be. And I will tell you that from having been in the financial industry and worked with people and their money, if you recommend something and in the early year or years it does well, it completely changes
Mhm.
their sense of comfort for the bad times that come along. They're ready for it. You've been warning them for years, and in the meantime, they've been making lots of money. That just feels great. And they even think, even though we tell them that we have nothing to do with it, that the market makes you money. I can't make you money. The market makes it, because and they also, by the way, think of us when they lose money too. So that's not right either. We can't take credit for the money they lost. But I want to, one, prepare her for the long-term holding of a couple of very simple asset classes. And if we mix international, then maybe a time comes along that everybody's worried about war or something. I mean, there's some reason, or there's a long period of time that internationals don't do well. My sense is it could blow the whole thing because somebody gets a hold of them and says, "Are you crazy? You've got a third of your money in international? That's outrageous." Well, you've lost money because you're in there. Well, I don't want that to happen. And so the judgment on my part is, what can we do? What can we do for her that when she sees what it did for her, that it will help imprint the desire for it to be a long-term commitment. And my goal is, for people who are interested, is to share the letter. And I don't know if I'll share the video. That my wife might not be comfortable with that. I wouldn't mind. I would like to encourage people to do something like that for people that they're leaving money behind. So, and best wishes and love and all of that as well. It won't just be about the money, but it will be about the dream that we have for her. And so there you go. That's why. Uh, Daryl, I know you've helped young people. How have you recommended young people with that first $2,000 or whatever it might be do with that investment?
I'm not sure that I've actually done that substantially.
Oh, I thought you
With,
were giving advice to some young people and okay, we'll cut that.
well, I have to my nephew,
Yeah, that's what I thought.
but he follows the work of the foundation anyway. And so I don't need to give him advice because he gets it from you.
That's the perfect answer. Well, Chris, I'm going to ask you this one then.
Okay.
This I talked to her for about an hour. Lovely lady, and she really, again, big kudos for you guys and the passion and willingness that we have to share the knowledge. She says, I've learned so much listening to your podcast and reading your work. I'm helping my two children, 20 and 22, new graduate, one of the 22-year-old, helping them get on the path to financial independence. They both have Roths. One's in the total stock market, and they're considering with the next funding, the three-fund portfolio, uh, with 70% in the total market and 15% each in international and small cap value. And they're wanting to know whether she should add growth ETFs into the portfolio. Now, here's one of those cases. She likes our work. She really knows we're trying to help, but it's not having any impact. Well, wait a minute. She is giving money to help the kids. Maybe we had something to do with that.
She does have a 15% allocation to small cap value.
You are right. You are right. Bless her. But what
Maybe
about
we need to do a video on why the growth part of the market can be hazardous to your health.
you're right. That's a good point.
Yeah,
A good point. And we'll come
because
with
you know, growth sounds good. It's not, isn't that what I want? I want growth, right? I want my portfolio to grow.
I want
So
personal growth.
yeah,
Yeah,
but
it's a big word.
it's in some respects it's misnamed. It should be the expensive stocks or something, right?
Oh,
It's where people expect to get growth, and so they pay a high price to buy the stock. That's what growth is. And so when people ask, should I add growth to my portfolio? Of course, you should have as much growth in your portfolio as you can get.
yes.
But adding the expensive stocks that are labeled growth may not get you what you want. And so I think that some of those questions just come from a lack of understanding, a lack of knowledge of, you know, what does the growth segment of the market mean? Is that the part that's going to grow? Because of course I would want more of that, right?
Yeah.
And it's flipped upside down. It's the expensive part where everybody thinks it's going to grow because it has grown. And because it has grown, it's expensive. And so that means it's less likely to grow as much in the future. And also, it's got farther to fall when things go sideways, when there's an earnings miss, or there's news about a regulation, or there's a tariff on that stock. It's got farther to fall, and it will. So I think people who are asking this question are probably coming at it from that kind of an understanding. It's like I just don't
I
get
think
why
you're
wouldn't
right.
I want growth in my portfolio? Yeah.
I think that's great, Chris. And to think back to the late 90s, uh, when companies were selling at PE ratios like Tesla, and higher. In fact, a lot higher. They had more hope in those companies than Tesla, and these were companies in many cases that weren't making either any money or much money. Many of them losing money, and of course, that's an infinite PE ratio. Um, but those stocks fell over 80% in the 2000 through 2002 period. But the other part of that story is, if you looked at the period of from 95 to 99, the value stocks compounded at about 11, while the growth were compounding at, I think, over 30 for a 5-year period. The growth, not the blend, but the growth. And then for the next 3 years, while that one group was going down 80%, the small cap value, I made money at the end of that 3-year period. Made money. They had one losing year and two. In fact, I think one of those years they were up 22%. And of course, we all live for a replay of the part of the life that we liked, and we're not promised that. We never know. But I do think your point is really well made, and I appreciate it. And Daryl, are you going to weigh in with any comment?
Well, the comment I would make is that these children, her children are young. They're 20, 22 years old.
Yeah.
And they have an incredible time horizon in front of them. And that is such a great resource that they ought to take advantage of it. And the way I think you can take advantage of it with a long time horizon like that is to be able to take the risk to have it pay off in the long run. And as we've seen in the past, not saying it'll happen in the future, but in the past, over periods of time that are measured in decades, taking that risk in terms of a small cap value fund, let's say, has paid off in the past. Chris's 2 funds for life, with a target date fund and an allocation to a small cap value, is a perfect example of something that they could do, that has a little bit of stuff that's maybe not real risky, but you're making a bet, that historically over longer periods of time has tended to pay off. And what do you think about that approach, Chris?
I like the idea of nudging them to at least consider the inclusion of some allocation to small cap value for the reasons you gave. And I think I just had this conversation with my grandson this morning. I think a good way to have that conversation is to teach them the rule of 72. Because for a person who has a lot of years ahead of them, it doesn't take very long playing around with the rule of 72 to start to realize that a little difference in return can make a huge difference in outcome. And my grandson and I were having this chat. We said, well, how long until you retire? Which that took a little while, but he kind of came up with about 50 years with luck, you know. And so then you take the rule of 72, which says you divide 72 by the return you're going to get. And if you're in the stock market, that's 10%. That would be 7 years. So you take 72 divided by the return of 10%, you get 7. That's how often your money would double with that return. So 7 times 7 is 50 years. That means my grandson has potentially 7 doublings by investing in the stock market. So it took him a while to figure that out, but then he goes, oh my gosh, that's 128 times, right? That's a big bump. And then you go, okay, well, what about 12%, which is small cap value? Well, 72 divided by 12 is 6. How many 6s do you get? Now you get 8. That means you got twice as much at the end for the part that you put in small cap value, right? Now you got 256 as your multiplier. So playing around with the rule of 72 with a young person is awesome because it teaches them 2 really important things. Number 1, the power of time that they have, and number 2, the power of compounding that they have. And those
small differences. Small differences can make a big difference.
Huge differences in the outcome. So
when you have time.
I think, yeah, it was a fun conversation with my grandson, and I'm hoping I get him to actually do something with it all.
Well, you know something, with that those comments, I think we ought to end and by the way, I understand why all these people think that you're great. I mean, I suspect there are a few people out there who are going to use the rule of 72 to teach a lesson, and that's
I hope
wonderful.
so.
It's wonderful. Thank you both, Chris and Daryl. You're wonderful partners, and we'll be back. And remember, I promised you this next time the three of us get together, it's going to be a hot one. It's going to be really interesting. So be sure and join us. We don't know when for sure, but we know what we want to talk about. So thank you. Thank you for watching, listening, reading, recommending, financially supporting. Thank you for that. Uh, and uh, and the other thing that people are doing that I asked in a recent podcast, I've gotten several recommendations. We want to expand the list of truth tellers, people that you have found to be great teachers that don't have a conflict of interest and that you think are straight shooters and always teach in the best interest uh, of the listener or the learner. And by the way, I'll tell you these two young people over in the UK who are teaching these free Rebel finance classes. Try one of them. They're free. They're really out to change people's lives, and they really don't charge anything. And they don't have a an upsell to a $3,000 1 week package. It's just good, raw, emotional, along with good number information that I think you'll enjoy. I'm enjoying it. Thank you all very much. Thanks, guys. Talk to you soon.